The debt ceiling is a cap on the total amount of money that the United States can borrow to fund the government and meet its financial obligations. It was created under the Second Liberty Bond Act of 1917 and is also known as the debt limit or statutory debt limit. The current debt ceiling is set at $31.381 trillion, and the United States officially hit that limit on Jan. 19, 2023. Why does the debt ceiling matter for investors? Because if Congress does not raise or suspend the debt ceiling by June 1, 2023, the Treasury Department will run out of cash and extraordinary measures to pay the government's bills and avoid a default. A default means that the United States would fail to pay its obligations, such as interest on the national debt, Social Security benefits, Medicare reimbursements, military salaries, and more. This would have severe consequences for the economy and the financial markets. A default would erode investor confidence in the U.S. government's ability and willingness to repay its debt, which is considered the safest and most liquid asset in the world. This could lead to higher interest rates, lower bond prices, reduced demand for U.S. Treasuries, and a weaker dollar. A default could also trigger a credit rating downgrade, which would make borrowing more expensive and reduce the value of U.S. debt holdings. A default would also disrupt the functioning of the financial system, which relies on U.S. Treasuries as collateral for many transactions. A default could cause a liquidity crisis, a credit crunch, and a spike in market volatility. A default could also spill over to other countries and regions that depend on U.S. trade, investment, and aid. A default would also damage the reputation and credibility of the United States as a global leader and a reliable partner. A default would undermine the U.S. dollar's role as the world's reserve currency and weaken America's influence and leverage in international affairs. In short, a default would be a financial and geopolitical disaster that would hurt investors and everyone else who depends on a stable and prosperous U.S. economy. How to play the debt ceiling game and win. You could give some tips and strategies for investors to prepare for and profit from the debt ceiling showdown, such as diversifying their portfolio, hedging their bets, taking advantage of market volatility, and looking for bargains in undervalued sectors. The debt ceiling is the legal limit on how much the federal government can borrow to pay its bills. It's a political tool that Congress uses to control spending and influence fiscal policy. But it's also a source of uncertainty and risk for investors, especially when lawmakers play a game of chicken with the nation's creditworthiness. If Congress fails to raise the debt ceiling by June 1, the Treasury Department will run out of cash and extraordinary measures to avoid defaulting on its obligations. That could trigger a series of negative consequences for the U.S. economy and the global financial system, such as higher interest rates, lower credit ratings, reduced government services, and a possible recession. So how can you protect your portfolio and even profit from this scenario? Here are some tips and strategies to consider. Diversify your portfolio. Don't put all your eggs in one basket. A balanced portfolio of stocks, bonds, cash, and alternative assets can help you weather any market turbulence and reduce your exposure to any single sector or country. For example, you may want to allocate more of your portfolio to international stocks or emerging markets that are less affected by U.S. politics and debt issues. Hedge your bets. You can use various instruments and strategies to hedge against the downside risk of a debt ceiling crisis. For example, you can buy put options or inverse exchange traded funds, ETFs, that profit when the market goes down. You can also buy gold or other safe haven assets that tend to rise in value when investors seek safety and stability. Take advantage of market volatility. A debt ceiling showdown can create opportunities for savvy investors who are willing to take some calculated risks. You can use volatility-based indicators and strategies to identify entry and exit points for trading stocks, options, futures, or currencies. You can also use stop-loss orders and trailing stops to protect your profits and limit your losses. Look for bargains in undervalued sectors. A debt ceiling crisis can create distortions and inefficiencies in the market, leading to some sectors being oversold or undervalued. You can use fundamental analysis and valuation metrics to find stocks or ETFs that are trading below their intrinsic value or historical averages. You can also look for sectors that are resilient or benefit from a debt ceiling crisis, such as healthcare, utilities, consumer staples, or technology.